Whew. Facebook down $48 in after-hour trading. This is why you don't trade when the earnings call, before. Anyway, so what I was going to talk about is one simple, my favorite spread for options that gives me the highest return. Well, highest likelihood, probability, not necessarily the highest return the way you're using it. It's called a credit spread. And first and foremost, what you have to do is you have to go to settings, and then you have to go to options trading. And you see right here where it says buying and selling spreads, that has to be enabled. And there should be another icon here if you're only at level 2 options, and it's adding level 3 basically. So you're going to click on buying and selling spreads, and then you're going to apply for level 3. And the reason why you have to do that is because you have to have so much collateral to be able to purchase or sell calls and puts. In other words, you have to have enough collateral to put that money up if you're going to sell it, because you could get executed and have to purchase 100 shares, depending upon how many contracts you have. So let's just theoretically saying that you are level 3, and you can either do a bullish credit spread or a bearish credit spread. And for instance, let's say right now Facebook has gone down $50 over just in the last hour because of the trading call here. And let's say I'm bullish. I'm thinking it's gonna go up. So I'd go to trade options, and obviously you get to pick the expiration date, whatever you want. You could do, a month from now or a week from now, which would be August 3rd. Let's just do a month from now. And you can always purchase out, close the spread at any time you want. So it's not locked in. But what I love about the credit spread strategy is you're not trying to predict where the market is going to go. You're trying to predict where the market is not going to go. So you can make money if the price stays stagnant. If it stays at this 165, you can make money if it goes up. And then you can also make money if it goes down, depending upon where you put your strike prices here. So like I said, you can make a lot more opportunities to nail in a profit, as opposed to if I was just to buy a put. I'm like, I'm not going to make money if it goes up. I'm only going to make money if it keeps going down. And vice versa. If it's a call, I'm only going to make money as it goes up, not if it goes down. And so let's just get into it. And some terms you guys should know is you should know when people talk about OTM or ITM, it's in the money, out of the money. And for calls, the strike price right now is this 166, and anything above this line is out of the money. So, obviously they're going to be cheaper to purchase, and anything below is in the money. So they're going to be more expensive to purchase. And the exact is opposite for puts when, you're shorting the stock when you're thinking it's going to go down. So strike price is 167, or the actual stock right now is, 166.58. It's changing every time. And now everything above that line is in the money, ITM, and everything below that money is OTM. So when it comes to this credit spread strategy, and the reason why it's called a credit spread is because you're receiving a credit payment of premium to put on this trade. So obviously if I stay closer to the couple out of the money, I'm going to make more money. But the way I make this work, and the way you have a higher probability of locking in a profit is I try to stay wherever I think it's not going to go. Let me use not Facebook for this example. Let's use, where's Netflix? Man, Netflix is going good. So let's just say a week from now. And where is the... I'm like way up here. Dude, Netflix has got a lot of option strikes. Anyway, so I'm thinking Netflix is going to go up. So I'm going to do a bearish credit spread. So which means I'm going to buy and sell a put for a spread. Yes, you're thinking, why are you going to, Johnny, why are you doing a put if you think it's going to go up? Because I'm trying to predict where it's not going to go. And what I'm going to do is I'm going to sell one out of the money put at a strike that I don't think Netflix is going to get to by August 3rd. So that's a week from now. So you see this nice little chance of profit, 66, 70, 78, 83. Well, you know, let's just go, I feel comfortable with 83. Oh, but like I said, first you have to have level 3, and then we have to go to this select, because now you're going to be able to buy and sell, or however many contracts all in one get-go. So I am going to click on sell the 342.5 put, because I'm thinking Netflix is not going to reach that level. And then I'm going to buy an even further out of the money put. So now I'm going to go to buy, and I'm going to do the 340. So as you can see, it's a spread between this 96 and 74. And I'm going to go to my options, and now, you know, I'm buying one, or excuse me, I'm selling one for 96.96, which is essentially $96, and I'm buying one for 74. So I'm now getting a credit of $22, and that credit is going to go directly into my account, and I get to keep that as long as it doesn't get to, where did I have this? As long as it doesn't get to this 342.5 by expiration. So what I'm wanting is I'm wanting it to, these to expire worthless. So obviously I don't have as much collateral because I've got some other credit spreads currently right now. But you can see, you know, I only need $156 as far as collateral for this trade. And granted, like I said, you know, that's not a whole lot of money, you know, but I could, obviously, I've got a good probability of success, and, you know, I could definitely make this higher, you know, so now I could be, you know, doing out of the money, and you can see I'm going to make $16,000 on premium right away. And then, if I wanted to do another one. Now, here, you know, I'm going to have a credit of $168 in my pocket. But this contract goes till December 21st. I can always close it out later, but, you know, it's your guys' risk as far as what you want to go with. I'm just here to show you how to actually do it. Here, I guess let's go back in there real quick, because you can make a lot more money if you were to sell a naked call, for instance. So let's use that same August 3rd. Let's sell naked put, sorry. So let's do the same. So I can sell this one, and I get a credit of $96. But as you can see, because it's a naked call, I need to make sure that I've got enough money in my cash account to be able to cover if it gets executed. So I need to have $34,156.53. And not many people have that over there, you know, and I'm only going to gain $96 if this expires. But I do have an 83% chance. So that's why doing the credit spread, again, I'm going to sell an out of the money strike price, and then I'm going to buy an even further out of the money. And then I'm going to get to keep what's... Sorry about that. I'm going to get to keep the difference of the premium. You know, so here I'm only going to make $22, not the 96, but I've got less risk and I hardly need any collateral. I don't need $34,000. You know, I just need 156. And I'll show you a couple that I've done recently here. Let me go up to my options here. So here's one that I did where I did AMD, and then I have another one that I sold at a 1550. So for 58.39, you know, average credit is going to be 13 into my account. It expires on Friday, and then same thing for Snap. I've got one here that I purchased $12.50, excuse me, I can't talk, and then I sold one for 13, you know, and right now Snap prices is at 12.81, and it can't go down to 12.50. So there's a couple just as the ones that I've done so far, but I hope this is helpful. I know it's kind of a longer, more drawn out video, but it's to help, and I will get into more iron condors, debit spreads, butterfly spreads, advanced butterfly spreads, butterfly broken wing spreads. I mean, I can get into a lot more, but this is by far one of my favorite strategies. That it's not going to make you rich unless you trade a lot, like, I mean, a hell of a lot. So, but it's definitely going to lock in some profits for you guys. And I'll go through some other strategies as far as how much are you willing to risk, you know, risk versus reward, as far as risk $10 to lose $1, yada, yada, yada. Oh, hey, look, I'm on Ethereum. Anyway, this is Johnny Crypto signing off.